How much Bitcoin do you need right now to retire in about 10 years? And how much would that cost? We're going to be going through that here today. We're going to probably have some pretty bullish price targets, but if you're watching this channel, you probably think Bitcoin's going to do quite well over the next 10 years because I talk about it a lot. And we are not going to get to the extreme bull category. There are some people, for example, someone that just came on Altcoin Daily's channel, that expect or say that Bitcoin could hit $15 to $100 million in the next 10 years, largely due to inflation spiking. Now, we're not going to be that bullish. We're going to give some realistic price targets out here today and talk about, depending on what kind of retirement you want, whether you're rolling on the beach in cash on some tropical island, or if you want to just be able to retire in 10, 15 years without having to invest more towards your retirement and everything in between.
Lyn, the goal of a retiree needs to be to outperform, like hopefully to grow more than the cost of those real world consumption that they're going to want to do in their retirement. So looking at the next 10 years, how do you think about tackling that challenge of growing more than that benchmark?
If you've ever heard of FIRE or financial independence, retire early, that's great because we are going to be going through how you can hit some of these different milestones. Now, if you don't know what that is, that's completely fine. It's basically the idea that you're able to retire when you hit a certain amount of money, depending on your expenses. Typically, we use this for S&P 500 indexes. So basically, we're saying that the safe withdrawal rate is 4% of your portfolio. Basically meaning that if you have $1 million in an S&P 500 index fund, you should be able to withdraw $40,000 a year based on historical data, and you should be safe to be able to withdraw 4% a year for the next 30 years. Only in about 3% of circumstances, or maybe it's 4 now, you would run out of money over 30 years. Now, we're going to make the assumption that we can use this 4% safe withdrawal rate. Obviously, if we have better returns or Bitcoin has better returns than the S&P 500, we could withdraw a lot more. For example, over the last 10 years, you could withdraw a lot more than 4% of your Bitcoin bag every year, and you'd still be able to continue to grow your overall net worth with Bitcoin because of the outsized returns. Now, there are a couple different ways that we can use this. So the traditional way of looking at financial independence, retiring early, is with this safe withdrawal rate and just looking at your expenses. Now, if you have normal expenses in the US, you could be looking at maybe $65,000 that you'd need a year. Some people need a lot more depending on your area. Some people, $200,000 wouldn't be super extravagant if you're in New York or somewhere very expensive. So we're going to assume that you're kind of in the middle. If you're looking at traditional FIRE, we're going to assume that you need $100,000 a year. You have $100,000 worth of annual expenses. And if this isn't making sense yet, it will make sense here in a second. But there are some ways that we can get to FIRE faster. You can do something called lean FIRE, which is basically not covering everything that you could ever want. So you're not going on lavish vacations. You're not spending a lot on cars, that kind of thing. Maybe you're eating out a little bit less. You're basically just covering your housing, your food, your basic food, any kind of medical expenses, basically the bare minimum that you need to live on. We're going to say that's $50,000 a year. So $4,000 a month, I think, could handle a lot of people's expenses that are, just the expenses that you have that you need to live on. Basically nothing, like I said, nothing that expensive, nothing that extravagant. And then if you want to get to FIRE even faster, and again, we'll put numbers to this, how much you need for Bitcoin, but we're going to assume that we could also do something called Coast FIRE, which is basically you're able to hit a certain dollar amount and then not have to put any more towards retirement for a number of years. So if, for example, maybe you have a couple $100,000 in an investment account by the time you're 30, then you realize by the time you're 60, that'll be enough to retire off of. We could do that with Bitcoin too. We're going to assume a 10% CAGR or 10% compounded annual growth rate after 10 years. So after 2033, we have enough Bitcoin to retire, and we're going to assume this 10% compounded annual growth rate for the next 20 years. And that means that we can go into traditional FIRE after that. So basically, after those 20 years, after we're done accumulating by 2033, we could go into traditional FIRE and have $100,000 worth of annual expenses. Again, this will make more sense here in a second, but this essentially allows you to get more growth and just not put more towards retirement. So maybe you can cut back on your hours or take a less stressful job in those 20 years, and then you'll hit traditional FIRE after that. And then what if you want to live it up a little bit more? What if you want to invest a little bit more here today, and then you want to be able to spend more down the road? Let's take a look at how much you need then. If you had fat FIRE, let's say you wanted to, again, spend $20,000 a month. You wanted nice cars, you want a Tesla, you want a really nice house, you want to take vacations. We're going to assume that you need $250,000 a year for annual expenses. And then the last thing I want to look at is also the filthy rich FIRE. I made this one up myself. All these other terms are pretty commonplace in the FIRE community. Filthy rich FIRE is being able to retire with a ton of money, being able to bring in $1 million a year, basically, for anything you want. We could spend $80,000 a month. Some people out there do make a lot of money, so maybe they want to be able to spend a lot of money in retirement as well. So assuming all this, we need to know the price of Bitcoin. Now, it's impossible to see 10 years into the future, but I put some different price models here, and we're starting off at 100,000. I think that's pretty bearish, honestly, because we were just at 65,000 just a couple over a year ago now. We were at 65,000 or 68,000. So that would just be a 50% increase from the top over the next 10 years. I think that is bearish, but we're going to include that price. We're going to include a $250,000 price target, about a 10x from here. We're going to assume a $500,000 price target, which is still less than it would still put Bitcoin at less than the market cap of gold. And that's assuming gold doesn't go up in price at all over the next 10 years. So I think that's a little bit bearish even too. I think we'll be above 500,000. I think $1 million is maybe pretty appropriate. That will probably be around the market cap of gold in 10 years. And then we put a $2 million price as well. Not extremely bullish, not bearish either. A little bit more on the bull side, I think, for most people. That would be a very nice return from here. I mean, we're talking about nearly a 100x. But keep in mind that we have done more than 100x over the last 6 or 7 years as well. Over the last couple cycles, we have been able to come from bottom to the top much more than where we would go here, from 23,000 to 2 million. So I've talked a lot. Let's get down to the numbers. If Bitcoin was going to hit 100,000 and we want to be filthy rich FIRE, right? We want to have so much money to spend in retirement. How much Bitcoin would we need? Keep in mind that we would only have a 4x. So we would only have a 4x from today's prices, and we want to be able to spend $1 million a year. We need 250 Bitcoin. It's a lot. And let me break down the numbers real quick, but this is the most that we need in any of these examples. You want to spend $1 million a year, right? You need 25 times that if we do the safe withdrawal rate of 4%. And then Bitcoin is only going to be $100,000. So again, you're going to need about $25 million worth of Bitcoin, spending at 4% a year, and Bitcoin's only going to do a 4x. So you're going to need a lot of Bitcoin from here. Now, what if Bitcoin's price goes up more? Because I think this is pretty bearish. Keep in mind, again, you're talking about spending a lot of money, and you're talking about Bitcoin not moving up that much in this example. Well, as we go down, we can see in the more extreme example, let's say $1 million. Bitcoin hits $1 million. We need $25 million, again, of Bitcoin. That means that we would need about 25 Bitcoin. So that's pretty expensive for a lot of people. There's some ways that we can bring this down, the amount that we need down, which we'll go through in a minute here. But let's say, we don't have that much money. I don't have this much money, right? I don't have 100 Bitcoin or anywhere close to that here today. So let's say we want fat FIRE, right? $250,000 a year. That's still a lot of money. That's still a lot of money to spend. If Bitcoin hits that $1 million mark, we need 6.25 Bitcoin. Okay, well, that's still a lot. It's better, but we're still going to need a lot of money if we want to spend $250,000 a year at 4% withdrawal rate. Let's say traditional fire, because this is getting me a little bit depressed here, right? Traditional fire, we can still spend $100,000 a year. Any kind of extra income that you make on the side or any other kind of investments, because I do think it's smart to diversify, right? Any kind of other investments would just be a cherry on top of the sundae there.
Have the benefit of having families in both the US and Egypt. I have homes in both countries. And so people in Egypt, when they're tackling this question, they're tackling it in the context of 20% annual, just the year after year money supply growth, right? And so obviously they can't be like, well, as long as I have enough Egyptian pounds, I'm good, right? They have to think, how many dollar equivalents or energy equivalents or gold equivalents do I have, or how many real estate equivalents do I have in terms of what I'm saving, right? So the worse your currency environment is, with the extreme end being like Venezuela or Lebanon or Argentina, and to middle extent being like Egypt or Argentina, and then to the benign extent, relatively speaking, being Europe, Japan, or the United States, you have to think, okay, there's a certain unit bias here.
Yeah.
And so, you know, in the US, money supply goes up by 7% a year on average. Obviously, it's been a bit weird in recent years, but over the long arc of time, it's been about 7%. And some of the more energy or labor intensive prices we have, so hospital services, oil, gold, housing, right? Those type of things are closer to maybe not money supply, but like money supply per capita, right?
Yeah.
So if money supply is 7% per year, money supply per capita might be 6%, might be 5.5%, depending. And so that's kind of your benchmark for like high-end resource intensive services. And then of course you hopefully benefit from technology. So when technology gets better, so processing gets better, offshoring gets better, we make a tire and shoes more cheaply than before. All of that tends to go down and help lower our average cost basis. But when we kind of like picture the American dream basket, so single family home, good healthcare, education for our children, um, that kind of, like just that kind of stuff, that's towards the higher end between, say, CPI and money supply growth per capita. We basically don't want to get diluted in our share. And so we have to think more in not just in nominal terms, but in those purchasing power terms. And we've had in the United States, we have the benefit of a 40-year bond bull market, so interest rates ever lower, equity valuations ever higher. When we think more globally, most equity markets don't go straight up and to the right, right? So Europe equity markets like literally like flat in dollar terms for like 20 years. Japan flat in dollar terms or even yen terms for like 30 years. Emerging markets often flat in dollar terms for 15 years or more. So the let's say 5 or 6 billion people in the world, equities are not really cutting it. It's the U.S. has kind of been the exception there, and we've had to basically just constantly drop interest rates and constantly boost equity valuations in order to achieve those very high results. And so if we say, okay, we're maybe let's just say we're maybe not going to repeat that for the next 30, 40 years.
30, 40.
Right. So if that's the case, if we can't rely on the best ever equity market in the world continuing to do what it's done, or that whatever equity market we're in, if we can't assume it's going to be like a top decile outperformer, what else can we do? And
What
a
historically,
historically a balanced portfolio gives us better risk adjusted returns. So it's like equity, real estate, whatever money is at the time. It could be gold, it could be fiat, it could be short-term bonds, could be tips, whatever money like instruments. Obviously, in the modern environment, that could be Bitcoin. Um, and one of the better hedges is commodities or commodity producers, because generally you go through a period of roughly 2 decades of commodities doing poorly, disinflationary growth-oriented stocks doing great, and then usually a decade or so of the opposite. So growth-oriented stocks being overvalued and getting killed, and all of those commodities and commodity producers going up like 5x, right? And so having some distribution among these various types of often non-conforming asset classes is a good way to ensure the probability that you can rather gradually grow your real purchasing power into retirement